Welcome to the Canadian Investors course, Session 1, Income Investing. Please review Slide 2, Terms of Use and Disclaimer. Well, we start with a cartoon. We've got Bernanke on the left and some Goldman Sachs bankers in the form of Medicis on the right. Mr. Bernanke saying these are very fine bonds indeed. And the nice people from Goldman Sachs are saying, I think he's buying it. In other words, a sucker's born every day. Fixed income investing. It's divided into three categories. Short term for the bond market is 30 days to 5 years. These are not GICs. Medium term is 6 years to 10 years. Long term is 11 to 30 years. Short term bonds are 30 days to 5 years. They're interest-bearing investments. They include Canada Treasury bills, provincial bills, term deposits, bankers' acceptances, corporate paper, money market funds, CSBs and OSBs, that's Canadian Savings Bonds and Ontario Savings Bonds, term deposits, and GICs. Why does the bond market envision 5 years as short term? Well, there's life beyond a bank account. Interest-bearing investments are available to Canadians, and they range from 30 days to 30 years, and 2 years to 30 years involve the bond market. The year one is considered cash equivalents. So Canada Treasury bills. Why do we like them? Well, first of all, they have CIDC insurance. That's the Canadian Deposit Insurance Corporation insurance. They're the safest investment, and they come in maturities ranging from 30 to 360 days. They also pay very low interest rates. In other words, low risk, low interest rates. So, buying a Canada T-bill, choosing the maturity and quantity, and then determine how much to invest. They're bought at a discount, and they mature at par. So in other words, take the example we've got here. You buy a $25,000 90-day T-bill at 3%. Well, the cost of that T-bill at 3% would be $24,821.21. So when it matures at $25,000, it matures at the original cost of $24,821.21 plus the interest the 3% interest for a total of $25,000. All T-bills, bankers' acceptance, and corporate short-term paper are sold at a discount to their par value, just like these T-bills. Other short-term money market instruments include bankers' acceptance. They come in $100,000 denominations. The idea is these are for a larger dollar amounts. The T-bills can be bought in any amounts, and then $1,000 increments after that. Corporate paper is the same as bankers' acceptance, except that it's paper issued by a corporation guaranteed by a bank. Money market funds are high-interest savings accounts and also referred to as HISAs. And you should shop around for your money market funds and make sure that they're covered by CDIC. Don't buy money market funds which are not covered by the government protection plan. And there's a credit rating for everything in the bond market. In the money market, credit ratings go R1, R2, R3. R1 is the highest, R3 is less high. And most investors want money market to be very high quality, so they stick to the high quality R1 paper only. You should too. Guaranteed investment certificates, or GICs. These are issued by banks, trust companies, and credit unions. And basically you're lending them money through your GICs for a while so that they can finance the mortgages that they issue. If you think that you may need your money back early, buy a GIC that allows you to change your mind without penalty. For example, a cashable one. Or buy it through one of your trusted wealth professionals who have the facility to trade them into the market. That's very important, because if you buy a GIC that can be traded in the market, you don't have to buy a cashable. You could buy a fixed term that's got a higher interest rate, knowing that you can sell it like a bond back into the market. They have a fixed term, typically, such as short as 6 months, 1 year. Some institutions have 1.5 years, 2 years, and very occasionally up to 10 years. But mostly the GIC market is 1 to 5 years. With some GICs, you need to get your money back sooner. You won't earn any interest. That has been made obsolete by the fact that a secondary market has been created in GICs with some dealers. Up to $100,000, most GICs have CDIC insurance, which means that you're protected as long as you only have up to $100,000 of GICs with one institution per client. So even if you have multiple accounts in your own name, you still have to have a maximum of $100,000. Or if you have multiple purchases, like a $30,000 of one and a $70,000 of another in the same account, different maturities, that still counts as your $100,000. And there's a secondary GIC market, as I said before. What's a secondary market? How does it work? And as a GIC investor, why should I care? And do I have access to that secondary market? Well, the answer is through your trusted wealth professional. You probably do, and you should contact them to learn more about that. As I said before, you should try and have all your GICs insured. So in other words, own as many as you like, but don't own any more than $100,000 per institution and in one account. And that way you'll have the CIC insurance on all your GICs. It's worthwhile. If you have 2 GICs in your RSP, then the first one's for $275 and the second one's for $165, all with the same institution. The CIC insurance is only going to cover the first $100,000 of principal interest on one of those GICs. However, if you had up to $2 million of GICs in your account in increments not in excess of $100,000 each, they'd all qualify for the CDIC insurance. If you'd like to know a little bit more about it, please refer to the hard copy, and you can go to the link and learn more about CIC insurance. How do you insure more than $100,000? Well, one way to do it is to get in your car and drive to 20 different banks and open 20 different accounts to have $100,000 in each account to cover your $2 million. The other option is you work with your trusted wealth professional and you buy GICs in multiple institutions in one account and make sure that you don't go over the $100,000 per GIC. And on top of that, your trusted wealth professional should be shopping around for best rates for you. So that doesn't cost you any extra, and it doesn't cost you any fees. Furthermore, the rates that your trusted wealth professional should be able to get you GICs for are as good as you're going to find them anywhere else in most cases. Western Canadian-based credit unions. Each province in Canada offers deposit insurance for credit unions and caisse populaire. Each province has different guarantee limits. BC has an unlimited guarantee, and below is information from the BC government site. You can read about this stuff on the hard copy. I won't go into it here. So the bottom line is, if you're not in Ontario and you're watching this presentation, go to your province's website and find out about which guarantees you're entitled to, because they do vary. And there are some exceptionally good deals in some provinces. Alberta had some good GICs at one point. Bottom line, this course is trying to encourage you to be a smart investor. Why place yourself or your family in an exposed position when you don't need to? You're becoming educated. That's a good thing. Can it happen here? You bet. Today, Deutsche Bank in Germany is in big trouble. 5 years ago or 10 years ago, that would have been absolutely unimaginable. So why would you take a risk when you don't need to? Go and talk to someone who can insure it all with no extra fees, all in one account. That's what your trusted wealth professional can probably do for you. You can go to the trustedwealthprofessional.com website and input your postal code, locate an advisor, or towards the end of this presentation, there's a phone number for Jerry Gabon. You can call him and he can direct you to one himself. So you can do it yourself online, or you can get help personally, whichever you prefer. That's the end of segment number 1, short-term fixed income investing. Thank you for your attention.